$5,000. I mean, I just want you to stop what you're doing and just sit with that number for a second.
$5,000.
That is where we have to start today, because gold has officially smashed through the $5,000 barrier for the first time ever.
It's a truly historic moment. There's really no other way to frame it.
And if that wasn't enough, silver briefly blasted past $115.
If you look at the charts, they are absolutely vertical. It looks less like a slow, steady commodity market and more like a meme coin from 2021.
Vertical is the word. We're talking about numbers that feel like they belong in a sci-fi movie. So welcome back to the deep dive.
Today, we're unpacking what everyone is calling the Great Rotation.
It's a fitting name. It really captures what's happening under the hood of the entire global financial system.
And there is so much tension in the markets right now because of this. Because for years, the whole thesis, the whole pitch was that when things got shaky, money would just flow into Bitcoin. That was absolutely the prevailing narrative. Digital gold. The idea was that Bitcoin was the hardest money, uncensorable, decentralized.
The ultimate lifeboat.
Exactly. The theory was when trust in institutions breaks down, capital would flee the old system and run straight to the blockchain.
But looking at the sources we've got today, that is not exactly what's happening, is it? It feels like the script got completely flipped.
Not at the moment, no.
Yeah.
The money is definitely flowing. In fact, it's flooding out, but it's bypassing the digital asset class entirely.
And heading where?
Straight back to the oldest assets on Earth. We're seeing a massive rotation into physical precious metals.
It's like we've gone back to the future, but the future is the Bronze Age.
In a way. But there's a very specific geopolitical reason for this that we really need to unpack. It's not just about inflation. It's about control.
Okay, so here's the mission for this deep dive. We're going to look at the triggers behind this massive move in metals, why central banks are suddenly hoarding gold.
We're also going to look at the sobering data coming out of the crypto ETFs, which are just bleeding cash.
Yeah, and we've got some pretty bearish signals from analysts, some technical stuff we need to break down so it actually makes sense. But stick with us, because it's not all doom and gloom.
No, not at all. There are some really interesting pockets of innovation happening that suggest crypto is evolving, even if the price is stuck in the mud.
I see what you did there. A little silver lining pun.
Had to.
But let's start with the big numbers. Section 1. This parabolic move in hard assets. Gold at 5,000. Silver hitting 115. These charts really do look like crypto charts.
They do, which is the great irony here. And to put this in perspective for everyone listening, roughly half of gold's entire dollar value has been created in just the last 20 months.
Wait, pause there. Half of its value? In less than 2 years. Gold's been around for millennia. How is that even possible?
It sounds impossible, but that's the reality. It just shows you the sheer velocity of capital pouring into this market. It's completely unprecedented. And you have to ask, why now?
Right. What was the trigger?
The sources point to a specific pivot point. It really goes back to 2022, when Russia's foreign reserves were seized by Western nations.
The sanctions. Right. That was a huge story, but we're seeing the ripple effects now.
Precisely. Since that moment, central bank gold purchases have literally doubled. It was a signal to the rest of the world that if you hold your reserves in dollars, they aren't truly yours. They can be frozen with the stroke of a pen.
So it's a trust issue. It's not just, I think the dollar will lose value. It's more like, I think my dollars could be taken from me.
It's a massive trust issue. The sources call it sovereign wealth confiscation risk. And now you're seeing countries like Norway, who are usually aligned with the West, issuing warnings. And Germany just made headlines saying they want their physical gold back from the New York Fed.
Germany wants their physical gold back. Yeah. That feels significant. That's like asking your bank for all your cash because you don't trust the vault.
It is a symbol of a breakdown in global trust. So the key insight here is that this rotation is not just an inflation hedge. It's a rotation into assets governments cannot control or devalue.
Which brings us to the elephant in the room. That was supposed to be Bitcoin's job. Unseizable money. Why isn't Bitcoin at $200,000 right now if the world is so terrified of asset seizure?
That is the crypto identity crisis we're seeing play out. Let's just look at the performance, the so-called catch-up trade. Bitcoin's sitting around $87,000, $88,000.
Yeah, and I have the stat right here. Since late 2017, Bitcoin is up about 500%. Sounds great. But silver is up 517% in that same period.
And that's the stat that just gut punches the Bitcoin is superior narrative. The shiny rock is outperforming the cutting-edge tech over nearly a decade. The market is voting that physical metals are the superior hard asset in this climate.
The market is saying, we want safety we can hold in our hands.
Exactly. Bitcoin is still viewed as innovation and risk. Gold is viewed as insurance. And right now, the world wants insurance.
Okay, so let's follow the money. Section 2, the flows. Because the data from the ETFs is, well, it's pretty stark.
It tells a very clear story. The spot Bitcoin ETFs, they just recorded 5 straight days of outflows. We're talking about $1.7 billion leaving the ecosystem in less than a week.
Is that panic? Are people capitulating? Because big outflows usually mean fear.
You know, what's interesting is the analysis suggests it's not panic, it's apathy. People are just bored. They're taking their money out to look for action somewhere else.
And the action is clearly in the metal ETFs.
The contrast is just shocking. While Bitcoin bled $1.7 billion, the iShares Silver Trust saw $32 billion in turnover on Monday.
Alone.
$32 billion in one day.
That is 15 times its daily average. It was more volume than any other security on Earth that day. More than NVIDIA, more than Apple.
Wow. So everyone is rushing into the same tiny door at the same time.
Which suggests retail investors are now chasing metals, and we might be nearing what's called a blow-off top.
Can you just define that for us? What's a blow-off top? Sure. It's a chart pattern with a super steep, rapid price increase on huge volume, which is then followed by an equally steep and rapid drop. It's driven by pure FOMO.
Fear of missing out.
Right. When your dentist is telling you to buy silver, you're usually near the top. But the key point for us is that crypto is sitting on the sidelines of this whole party.
It's like being the cool kid at school, but suddenly everyone's hanging out with a geology club instead.
That is a fantastic analogy, and it really raises the question, who is left to buy crypto right now?
Well, apparently the OGS aren't buying. They seem to be selling. Which brings us to Section 3, the bearish signals. I read this story about a whale wallet, and it honestly gave me chills.
The dormant Ethereum wallet, right?
Yeah. This wallet had been totally inactive for 9 years, since 2017. They bought their ETH back when it was $90 a coin.
$90. I mean, that's practically getting it for free in today's terms. A different world.
And this week, it finally woke up. Moved 135,000 ETH to Gemini. That's nearly $400 million.
397 million, to be exact. And they locked in about 385 million in profit.
So what's the psychology here? When a whale, that ancient someone who held through everything, decides to cash out now, is that a signal?
It's usually interpreted as smart money de-risking. These are the people who have seen it all.
Mm-hmm.
If they're selling now, it suggests they don't see a lot of immediate upside. It signals a lack of conviction.
And it's not just one whale. We have some technical analysis from Benjamin Cowan that paints a pretty gray picture.
Yeah, Cowan's analysis is very grounded in historical data. He talks about the bull market support band.
Okay, break that down for us. What is that?
Think of it like a moving floor for the price. Technically, it's a couple of moving averages, but in a bull market, Bitcoin's price tends to stay above this band. It bounces off it like a trampoline.
It's the safety net.
Right. But Cowan is pointing out that this band has now flipped. It's acting as bear market resistance. So every time Bitcoin tries to rally, it hits this band as a ceiling and gets pushed back down.
The floor became the ceiling.
Precisely. And he also pointed out something about midterm years.
Yes, what was that?
We're in 2026. It's a midterm election year in the U.S. And historically, if you look at 2014, 2018, 2022, those are all bear markets for Bitcoin.
Oh, wow. I hadn't connected those dots. 2014 was Mt. Gox. 2018, the ICO bust. 2022 was FTX.
Exactly. So 2026, fitting that pattern, would be the standard, not an anomaly. He compares the current market to 2019. Not a violent crash, just a slow bleed. A top formed on apathy.
Apathy, there's that word again. Just a slow, boring drift downward.
And his prediction is that a sweep of the lows from April 2025 is realistic. So the technicals and the history, they suggest you might be disappointed if you're expecting a sudden moonshot.
Okay, so the technicals are rough, the flows are bad. What about the government? Section 4, the regulatory standoff. Just a few weeks ago, we were all excited about the Clarity Act.
It really did feel like we were about to get, clarity. The betting markets had the odds of it passing at around 80%.
And now
it's a coin flip, politics and complexity. Coinbase's CEO actually came out and criticized the current version of the bill, calling it unworkable.
That seems weird. Why would the industry leader criticize the bill that's meant to help them?
Because sometimes bad regulation is worse than no regulation at all, but the end result is that all the momentum has just stalled.
So we're back in limbo.
We are. And without those policy tailwinds, crypto has to rely on something else to do the heavy lifting.
You have to rely on real adoption,
Which is much, much harder. And to compound all this, you have the macro view from analysts like Paul Barron, Rebecca Walser. They point out that the Fed is basically stuck.
Stuck how?
The market wants rate cuts. It wants cheap money. But with inflation still stubborn, the Fed probably only has one rate cut in the chamber. They can't just turn on the money printer like they did in 2020.
So the dollar is weak, but the Fed can't save it, and money is running to gold because crypto is still seen as too risky.
That's the perfect summary. Walser puts it clearly. Hard assets are winning the safety trade. Crypto is still in the innovation and risk box. It hasn't graduated yet.
Okay, I feel like we've sufficiently depressed everyone listening now.
It is a heavy landscape, I'll give you that.
Yeah, we promised it wasn't all doom and gloom, so let's pivot. Section 5, pockets of innovation. Because while the price is boring, the builders are actually building stuff that works.
This is the silver lining. The speculation phase is cooling, but the utility phase is definitely ramping up.
Let's talk about Hyperliquid. I've been hearing this name everywhere. Hit a new all-time high in open interest, over $790 million. What is it?
So Hyperliquid is a decentralized exchange. It lives entirely on the blockchain. But here's the twist. The volume isn't from people betting on dog coins. It's driven by people trading commodity stocks and metals on-chain.
Wait, so people are using crypto rails to bet on the gold rally?
Exactly. It's the ultimate irony. They are using the digital gold technology to get exposure to actual gold. But it proves the utility. It's fast, it's 24/7, and they're claiming tighter spreads on Bitcoin perps than even Binance now.
Okay, explain spreads and perps really quick.
Sure. Perps are perpetual futures, just a way to bet on the price. The spread is the difference between the buy and sell price. A tighter spread means it's cheaper to trade, and if a decentralized platform is cheaper than the biggest player in the world...
That's real product market fit. That is huge.
It's legitimate competition.
And then there's this hunt for yield. If the price isn't going up, people want to earn interest on their assets, and the big boys are stepping in.
They are. Bitwise just launched an on-chain USDC vault. It's targeting a 6% yield using something called Morpho.
What's Morpho?
It's a DeFi lending protocol, but Bitwise is wrapping it in institutional oversight, so you get DeFi yields with the safety checks of a traditional company.
DeFi with a suit and tie.
Basically. And then BlackRock, the biggest asset manager on the planet, filed for a Bitcoin ETF with a built-in yield strategy using options.
Okay, how does that work for a normal investor?
Think of it like a dividend. You hold their Bitcoin ETF, and BlackRock's team runs an option strategy in the background to generate income. They then pass that income to you.
So even if Bitcoin's price stays flat, you could still earn 5 or 10%.
That's the goal. It makes holding through a bear market much more attractive. It feels like a massive maturity step for the asset class.
It's not just number go up, it's asset generates cash flow.
It's the financialization of crypto. We're also seeing corporate adoption continue. Tom Lee's Bitmine just expanded their Ethereum treasury to over 4.2 million ETH.
4.2 million. They're not selling, they're stacking.
Exactly. And one last positive note, Polymarket just signed a multi-year exclusive deal with Major League Soccer.
That's real-world utility, moving crypto out of the financial corner and into mainstream sports and entertainment.
It's real people using the tech.
Okay, so let's try to synthesize this whole deep dive. Gold is exploding, Bitcoin is stagnating, whales are selling, but the tech is getting better. What does this all mean?
I think we're witnessing a historic divergence. Hard money is absolutely in vogue right now. But because of that confiscation risk we talked about, the definition of hard money has temporarily reverted to the physical. Gold and silver are winning the trust game.
Bitcoin's been put in the penalty box.
In terms of price, yes, the digital gold narrative is taking a backseat. But underneath the surface, the industry is being forced to mature. The casino aspect is closing, and the bank aspect is opening.
So the takeaway is, don't just look at the price chart and assume crypto's dead. Look at the products being launched and realize it's just evolving.
Precisely. The speculation fever has broken, which is painful, but it's necessary. Now we find out what this tech is actually useful for.
Growing pains. Just very expensive growing pains.
Very expensive.
All right, as we wrap up, I want to leave the listener with something to chew on.
I have a question for everyone to consider. For years, the entire crypto thesis was built on being the alternative to a failing fiat system. Well, the system is wobbling, but right now, the market clearly prefers a shiny rock from the periodic table over the blockchain.
So the question is,
what does Bitcoin need to do next to reclaim the title of digital gold? Is yield the answer, turning it into a productive asset? Or does it just have to wait for the regulatory dust to settle so institutions finally feel safe enough to trust code over metal?
That is the billion-dollar question. Or, I guess, the $5,000 an ounce question now.
It certainly is.
Thanks for diving in with us. We'll be watching those charts, both the digital ones and the shiny ones. See you next time.